Hello everyone, North Star VFD Consultancy, welcome you to this video on International Financial Reporting for Beginners. In this chapter we will introduce IFRS History, IFRS Framework, and in coming days we will introduce you each individual IFRS standards. We hope this series will be helpful to you to understand International Financial Reporting Standard and its applications. Before beginning, we would like to introduce ourselves. We North Star VFD, a financial management consultancy, provide services of financial planning and analysis, budgeting, cash flow, financial reporting, accounting and tax management. For more information, please visit our website www.northstarvfd.com. What is IFRS? IFRS, International Financial Reporting Standards, are a set of rules for accounting and financial reporting of companies that are intended to make financial reports consistent, transparent, comparable around the world. The authority to issue the standards are, in the past it was International Accounting Standards Committee, called IASC, which is established in June 1973. Now it is International Accounting Standard Board, called IASB. IASC published standard called International Accounting Standards, IAS. From the year 2001 onward, IASB replaced IASC, and IASB then continued to issue new standards called International Financial Reporting Standards, IFRS. All IAS standards which are not replaced by IFRS standards are continuing to be valid and applicable. European Union decided in 2002 to adopt IFRS standards with effect from year 2005. As of the 15th of August 2022, around 167 countries, including European Union and major economies like China, Japan, India, Russia, South Africa, Brazil, are adopted IFRS standards. United States follow a different system, US GAAP. However, substantial convergence of selected IFRS standards with US GAAP is adopted. The objective of International Financial Reporting Standards is to make financial statements coherent and consistent across different industries and countries. As globalization and integration of economies, cross-border investments are increasing, a harmonized international financial reporting standard is essential, as disparaging separate national standards make comparability and verifiability difficult. The harmonized financial reporting standard helps a platform for wider investment choice, more efficient capital market, lower cost of capital, enhanced business development. IFRS Conceptual Framework and its purpose. The IFRS Conceptual Framework itself is not a standard and it does not override any specific IFRS, it is relevant on following aspects. 1. The conceptual framework's purpose is to aid the IASB in developing and revising IFRSs that are based on consistent concepts. 2. To help preparers to develop consistent accounting policies for areas that are not covered by a standard or where there is choice of accounting policy, and to aid all parties to understand and interpret IFRS. 3. In the absence of a standard or an interpretation that specifically applies to a transaction, management must use its judgment. In making that judgment, management to consider the definitions, recognition criteria, and measurement concepts for assets, liabilities, income, and expenses in the framework. 4. In case of new or revised pronouncement that conflicts with the framework, the IASB must highlight the fact and explain the reasons for the departure in the basis for conclusions. The IFRS Conceptual Framework deals with basic concepts applicable to all IFRS standard and it deals with following subjects. 1. The goal of general-purpose financial reporting. 2. Qualitative characteristics of useful financial information. 3. Financial statements and the reporting entity. 4. The elements of financial statements. 5. Recognition and derecognition. 6. Measurement. 7. Presentation and disclosure. 8. Concepts of capital and capital maintenance. In subsequent section, we will look into aforesaid 8 concepts in details. The goal of general-purpose financial reporting. The IFRS concept framework defines objectives of general-purpose financial reporting as to provide financial information about reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions relating to providing resources to the entity. Those decision involves decision about buying, selling, or holding equity and debt instruments, providing or settling loans and other forms of credit, or exercising rights to vote on, or otherwise influence, management's actions that affect the use of the entity's economic resources. Other parties, such as regulators and members of the public, may also find general-purpose financial reports useful. Users of financial reports need information about a. The economic resources of the entity, claims against the entity and changes in those resources and claims, and b. How efficiently and effectively the entity's management and governing board have discharged their responsibilities to use the entity's economic resources. Qualitative characteristics of useful financial information. The IFRS conceptual framework states that the types of information likely to be most useful to providers of capital are identified by various qualitative characteristics, comprising two fundamental qualitative characteristics, that first one is relevance and second one is faithful representation. Relevance. Relevant information is capable of making difference in the decision made by users. Information may be capable of making a difference in a decision, even if some users choose not to take advantage of it or are already aware of it from other sources. Information can make a difference if it has predictive value, confirmatory value, or both. Predictive value means that the information can be used to predict future outcomes. The financial information itself does not need to be a prediction or a forecast but can be interpreted by users to allow them to make their own predictions. For example, current year revenue information could be used as the basis to predict revenue in future years. Confirmatory value means that the information provides feedback on previous valuations, that is, it allows users to confirm or change their opinion on such evaluations. For example, the same current year revenue information indicated above could be compared with revenue predictions which had been made in prior years, to correct or improve processes that were used to make those earlier predictions. Relevance of information is affected by its nature and its materiality. Information is material if omitting it or missing it could influence decision that users make on the basis of financial information about a specific reporting entity. Faithful representation. Financial reports represent economic phenomena in words and numbers. To be useful, financial information must not only represent relevant phenomena but must faithfully represent the phenomena that financial information is made understandable to users by classifying, characterizing, presenting it clearly and concisely. To be faithful representation, information must be complete, neutral, and free from error. Complete means all information necessary for users to understand the phenomenon being depicted, including all necessary description and explanation. Neutral means without bias in the selection or presentation of financial information. Free from error means there are no errors or omissions in the description of the phenomenon and no errors made in the process by which the financial information was produced. In addition to two fundamental qualitative characteristics, IFRS conceptual framework supplemented for enhancing qualitative characteristics that are comparability, verifiability, timeliness, understandability. 1. Comparability. Comparability enables users of financial reports to identify and understand similarity and difference of elements in financial report, which help user of financial information to decide on alternative choices of selling, investing, etc. Consistency. Use of same method for same item, either from period to period for reporting entity or single period across entity, helps to achieve comparability. For example, if a user of entity's financial statement wants to evaluate P&L performance, then user must be able to compare current period P&L against earlier period. To draw meaningful result, entity should consistently follow same accounting standard in current and previous period. Similarly, in case user want to compare performance of an entity against similar type of entity in same industry, meaningful comparison is possible only when both entities' financial statement is prepared consistently with same standard. 2. Verifiability. Verifiability assures users of financial information that financial report faithfully present economic phenomena it purports to be. Verifiability means that different knowledgeable and independent observers could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation. 3. Timeliness. Timeliness means having information available to decision-makers in time to be capable of influencing their decisions. The older the information is, the less useful it is. The information may become less useful if there is a delay in reporting it. There is a balance between timeliness and the provision of reliable information. 4. Understandability. Financial information is made understandable to users by classifying, characterizing, presenting it clearly and concisely. The financial reports are prepared for users who have reasonable knowledge of business and economic activities and who review and analyzes the information diligently. The general-purpose financial statements and reporting entity. The objective of financial statements is to provide financial information about the reporting entity's assets, liabilities, equity, income and expenses that is useful to users of financial statements in assessing the prospects for future net cash inflows to the reporting entity and in assessing management stewardship of the entity's economic resources. That information is provided 1. In a statement of financial position, by recognizing assets, liabilities and equity. 2. In the statements of financial performance, by recognizing income and expenses. 3. And in other statements and notes, by presenting and disclosing information about a. Recognized assets, liabilities, equity, income and expenses, including information about their nature and about the risks arising from those recognized assets and liabilities. B. Assets and liabilities that have not been recognized, including information about their nature and about the risks arising from them. C. Cash flows. D. Contributions from holders of equity claims and distributions to them, and E. The methods, assumptions and judgments used in estimating the amounts presented or disclosed, and changes in those methods, assumptions and judgments. Reporting entity. A reporting entity is an entity that is required, or chooses, to prepare financial statements. A reporting entity can be a single entity or a portion of an entity or can comprise more than one entity. A reporting entity is not necessarily a legal entity. In case determining the appropriate boundary of a reporting entity is difficult, in such cases, determining the boundary of the reporting entity is driven by the information needs of the primary users of the reporting entity's financial statements. The elements of financial statements. The conceptual frameworks of IFRS define the element of financial statements, that are assets, liability, equity, in statement of financial position, and income and expenses, in statement of profit or loss and other comprehensive income. The transactions and other events are grouped together in broad classes and in this way their financial effects are shown in the financial statements. These broad classes are the elements of financial statements. The definition of each element of financial statement as per framework are as follows. Assets are resources controlled by an entity as result of past events and from which future economic benefits are expected to flow to the entity. The definition of an asset is an economic resource subject to 3 criteria. 1. It is a right of the entity. 2. It has the potential to produce economic benefits. And 3. It is controlled by the entity. It is observed that rights that have the potential to produce economic benefits take many forms, including a. Rights that correspond to an obligation of another party, for example, rights to I. Receive cash. 2. Receive goods or services. 3. Exchange economic resources with another party on favorable terms. Such rights include, for example, a forward contract to buy an economic resource on terms that are currently favorable or an option to buy an economic resource, and 4. Benefit from an obligation of another party to transfer an economic resource if a specified uncertain future event occurs. B. Rights that do not correspond to an obligation of another party, for example, rights 1. Over physical objects, such as property, plant and equipment or inventories. Examples of such rights are a right to use a physical object or a right to benefit from the residual value of a leased object, and 2. To use intellectual property. Liabilities, which represents obligation of the entity arising from the past events, the settlement of which is expected to result in outflow from the entity of resources embodying economic benefits. For a liability to exist, three criteria must all be satisfied. 1. The entity has an obligation. 2. The obligation is to transfer an economic resource, and 3. The obligation is a present obligation that exists as a result of past events. Equity is the residual interest in the assets in an entity after deducting all its liabilities. Equity claims are claims against the entity that do not meet the definition of a liability. Increases in assets or decreases in liabilities that results in increase in equity. Expenses are decreases in assets or increase in liabilities that results in decreases in the equity, other than those relating to distribution to holders of equity claims. Other changes are exchanges of assets or liabilities that do not result in increase or decrease in equity, and contribution from and distribution to holders of equity claims. The definitions of financial elements are important. It will help to identify how a transaction or economic event is accounted and included in an element of financial statement. Whether an item satisfies any of the definition assets, liability, equity, expenses, income, or other changes etc. will depend on the substance and economic reality of the transaction, not merely its legal form. Recognition and derecognition. The IFRS conceptual framework had defined criteria for the recognition and derecognition of an item in the financial statements. Recognition. Only items that meet the definition of an asset, a liability or equity are recognized in the statement of financial position. Similarly, only items that meet the definition of income or expenses are recognized in the statements of financial performance. However, an asset or liability is recognized only if recognition of that asset or liability and of any resulting income, expenses or changes in equity provides users of financial statements with information that is useful. Derecognition. Derecognition is the removal of all or part of a recognized asset or liability from an entity's statement of financial position. Derecognition normally occurs when that an item no longer meets the definition of an asset or of a liability. For an asset, derecognition normally occurs when the entity loses control of all or part of the recognized asset, and b. For a liability, derecognition normally occurs when the entity no longer has a present obligation for all or part of the recognized liability. Measurement. As elements recognized in financial statements are quantified in monetary terms. This requires the selection of a measurement basis. Applying a measurement basis to an asset or liability creates a measure for that asset or liability and for related income and expenses. Measurement basis, defined in the framework, is historical cost, current value, fair value, value in use, or fulfillment value, and current cost. The IFRS conceptual framework does not provide detailed guidance on when a particular measurement basis would be suitable. Rather, it describes various measurement bases, the information they provide and the factors to consider. A standard may need to describe how to implement the measurement basis selected in that standard. Let us look into each measurement basis. 1. Historical cost. The historical cost of an asset when it is acquired or created is the value of the costs incurred in acquiring or creating the asset, comprising the consideration paid to acquire or create the asset plus transaction costs. The historical cost of a liability when it is incurred or taken on is the value of the consideration received to incur or take on the liability minus transaction costs. Unlike current value, historical cost does not reflect changes in values, except to the extent that those changes relate to impairment of an asset or a liability becoming onerous. 2. Current value. Current value measures provide monetary information about assets, liabilities and related income and expenses, using information updated to reflect conditions at the measurement date. Unlike historical cost, the current value of an asset or liability is not derived, even in part, from the price of the transaction or other event that gave rise to the asset or liability. Current value measurement bases include 1. Fair value, 2. Value in use for assets and fulfillment value for liabilities, and 3. Current cost. 1. Fair value. Fair value is the price that would be received to sell an asset, or paid to transfer a liability, in an orderly transaction between market participants at the measurement date. Fair value reflects the perspective of market participants, that is, participants in a market to which the entity has access. The asset or liability is measured using the same assumptions that market participants would use when pricing the asset or liability if those market participants act in their economic best interest. In some cases, fair value can be determined directly by observing prices in an active market. In other cases, it is determined indirectly using measurement techniques, for example, cash flow-based measurement techniques. 2. Value in use and fulfillment value. Value in use is the present value of the cash flows, or other economic benefits, that an entity expects to derive from the use of an asset and from its ultimate disposal. Fulfillment value is the present value of the cash, or other economic resources, that an entity expects to be obliged to transfer as it fulfills a liability. Value in use and fulfillment value reflect entity-specific assumptions rather than assumptions by market participants. 3. Current cost. The current cost of an asset is the cost of an equivalent asset at the measurement date, comprising the consideration that would be paid at the measurement date plus the transaction costs that would be incurred at that date. The current cost of a liability is the consideration that would be received. Presentation and disclosure. Financial statements are viewed in the IFRS conceptual framework as a communication tool wherein an entity presents and discloses information about its assets, liabilities, equity, income and expenses. Typically, the statement of financial position and the statements of financial performance provide summarized information, and more detailed information is provided in the notes of information in financial statements. Effective presentation of information in financial statements requires 1. Focusing on presentation and disclosure objectives and principles rather than focusing on rules. 2. Classifying information in a manner that groups similar items and separates dissimilar items. 3. Aggregating information in such a way that it is not obscured either by unnecessary detail or by excessive aggregation. Concepts of capital and capital maintenance. The concept of capital maintenance is concerned with how an entity defines the capital that it seeks to maintain. It is a prerequisite for distinguishing between an entity's return on capital, that is, profit, and its return of capital. The IFRS conceptual framework identifies two broad concepts of capital maintenance. 1. Financial capital maintenance, and 2. Physical capital maintenance. The principal difference between the two concepts of capital maintenance is the treatment of the effects of changes in the prices of assets and liabilities of the entity. The selection of the appropriate concept of capital by an entity should be based on the needs of the users of its financial statements. The concept of capital maintenance chosen by an entity will determine the accounting model used in the preparation of its financial statements. Most entities adopt a financial concept of capital. Finance capital maintenance. Finance capital means equity capital from issuing shares and debt capital by issuing bond or borrowing from banks. Physical capital maintenance. Physical capital means factors of production like land, plant and machinery, human resources, and factor includes human-made items or products that make the production possible or enable it to run smoothly. This is end of this chapter dedicated to IFRS conceptual frameworks. Thank you for watching this video. See you next time with another chapter of International Financial Reporting Standards.